In the next 20 years, an estimated 10,000 people will retire every single day in America alone. But here's the dark truth. The majority of them will not retire rich. They won't even retire comfortable. They'll retire broke, confused, and wondering where all their money went. And the worst part? It wasn't because they didn't try. It's because they made a few silent, deadly investing mistakes, the kind that destroy millions of retirements every single year. Today, we're exposing those mistakes, not to scare you, but to prepare you. Because your future wealth depends on what you do after watching this. The illusion of retirement wealth. Most people believe they're doing the right thing. They save money in their 401k. They invest in index funds. They listen to what financial gurus tell them. But when retirement finally arrives, reality hits like a brick wall. Their portfolio that once looked massive, $500,000 or maybe even $1 million, suddenly doesn't seem like much when spread over 25 years of retirement. Let's do the math. If you retire with $1 million and withdraw 4% a year, that's $40,000 annually. But factor in inflation, taxes, healthcare, and market volatility. And suddenly, your $1 million dream becomes a financial nightmare. The first mistake millions of retirees make is believing that saving is the same as preparing. Saving is defensive. Investing wisely is offensive. You can't win a game by only playing defense. The 7% lie, overestimating market returns. For decades, investors are told that the stock market gives an average of 7 to 10% returns per year. That's true on average, but averages don't feed you. Real returns do. Between 2000 and 2010, an entire decade, the S&P 500 delivered nearly zero real returns after inflation. Millions of retirees who assumed their portfolios would keep growing were blindsided. The problem wasn't the market. It was their expectations. When you plan your retirement expecting 10% annual growth, but reality gives you 4%, you end up drastically underfunded. A simple correction, assuming a 4 to 5% realistic annual return, can save your future self from disaster. Because the market doesn't care about your retirement date. It doesn't care if you're 65 and ready to cash out. The sequence of returns trap. Imagine two investors, John and Mary. Both have $1 million in retirement savings. Both plan to withdraw $40,000 per year. John retires in 2000, right before the dot-com crash. Mary retires in 2010, at the start of a long bull market. 10 years later, John's portfolio is down to $400,000. Mary's is up to $1.5 million. Same strategy, different timing. That's the sequence of returns risk. One of the most dangerous, least understood retirement killers. When you start withdrawing money during a market downturn, your portfolio takes a double hit. You lose value from both withdrawals and falling stock prices. This mistake wipes out billions in retirement wealth every decade. Smart investors plan for this by building a cash buffer, enough to cover at least 2 to 3 years of expenses without touching investments. That buffer gives your portfolio time to recover during market drops. The ones who don't prepare end up selling at the worst possible time. Ignoring inflation, the silent retirement killer. Inflation is the thief that robs quietly. It doesn't crash markets or make headlines every day, but it erodes purchasing power year after year. Let's say your monthly expenses are $3,000 today. With just 3% annual inflation, in 20 years, that same lifestyle will cost over $5,400 a month. If your income doesn't keep up, you're losing ground. Millions of retirees make the mistake of keeping too much cash or investing too conservatively because they fear market volatility. But being too safe is its own kind of danger. Cash sitting in the bank earning 1% interest while inflation is 4% is a guaranteed loss of purchasing power. The key is balance. Holding some safe assets for stability, but keeping enough growth investments to outpace inflation over time. Because the truth is, you can't save your way out of inflation. You have to invest smartly out of it. The emotional investor. Numbers matter, but emotions destroy wealth faster than any market crash. Panic selling, greedy buying, FOMO during bull markets, fear during downturns. In 2020, when the pandemic hit, the market fell over 30% in weeks. Many investors panicked and sold near the bottom, locking in losses. Yet by the end of the year, the market had fully recovered and reached new highs. Those who stayed invested not only survived, they thrived. The average investor underperforms the market not because of bad funds, but because of bad timing emotional timing. Retirement accounts are long-term tools, but too many treat them like day trading accounts. Every time you check your balance, your emotions want to react. The real pros? They ignore the noise. They automate contributions. They think decades, not days. Because in investing, patience isn't just a virtue, it's profit. Fees, the hidden wealth erosion. Most people never check the hidden fees inside their mutual funds or retirement plans. But those fees quietly drain wealth year after year. A 1% annual management fee might not sound like much, but over 30 years, it can eat up nearly 25% of your total retirement value. Let's say two people invest $500 a month for 30 years at 7% returns. Investor A pays 1% in annual fees. Investor B pays 0.2%. Investor ends up with $520,000. Investor B ends up with $610,000. Same contributions, same market, different outcome, all because of hidden fees. Smart retirees use low-cost index funds or ETFs, not expensive actively managed funds that rarely outperform a market. Because in retirement, it's not just what you earn, it's what you keep. Over-reliance on one asset, especially real estate. Many retirees believe property is the safest investment. They buy multiple houses, thinking real estate will always go up. But history says otherwise. In 2008, millions lost not only their jobs, but their homes and their supposed retirement equity. Real estate can be powerful, but it's not immune to crashes, rising taxes, or tenant issues. And it's not liquid. You can't sell half a house when you need cash. Diversification isn't optional. It's survival. That means spreading your investments across different assets, stocks, bonds, real estate, and maybe even small business or dividend portfolios. Because no single market has ever risen forever. Not having a withdrawal strategy. You can spend your entire life growing your nest egg, but if you don't have a smart withdrawal plan, you'll run out of money early. The old rule of thumb, the 4% rule, worked when interest rates and returns were predictable. But in today's world of volatility and longer lifespans, it's outdated. You need a flexible approach, withdrawing less during market downturns and slightly more during strong years. Think of your retirement plan as a living system, not a fixed number. Those who ignore this and stick to rigid withdrawal rates end up broke, years before they expected. The truth about retirement wealth. The truth is simple. Retirement isn't about luck, timing, or even high income. It's about discipline, avoiding common mistakes, and letting time, consistency, and knowledge work for you.